Let me tell you something a little uncomfortable. Most people don't lose money because they picked bad investments. They lose money because they picked the wrong account. Same investment, same returns, but one person keeps way more of it, and the other accidentally tips the IRS like it's a five-star restaurant. And the worst part, the tax advantage accounts that could save you hundreds of thousands of dollars are already available to you. Nobody just explained them properly. So today, we're fixing that. In this video, I'm breaking down what tax advantage investment accounts actually are, which ones you should use, and when, how to stack them together the smart way, and how to invest like a normal human, not a tax attorney. Here's the mental shift you need to make. Investments are what you buy, and accounts are where you hold them. Think of investments like groceries and accounts like refrigerators, same food. Very different results depending on storage. Some fridges keep things fresh, don't charge you fees, and don't steal a bite every year. Other fridges leak, tax you every time you open the door, and somehow make your ice cream disappear. Tax advantage accounts are simply better refrigerators for your money. To keep this simple, we will fit everything into 3 buckets. Bucket 1 is tax deferred, which means you pay taxes later. Bucket 2 is tax free, pay taxes now and never again. The last bucket is taxable. You pay taxes along the way. The goal here is not to pick one. The goal is to spread your money intelligently across all 3. So let's break them down. Now let's talk about bucket 1, tax deferred accounts. Think of these like your sneaky little cousins who hide from taxes just for now. Examples include the traditional 401k and traditional IRA. Here's how they work. You get a tax break today, which means more money to invest right now and your investments grow tax deferred. But later, when you withdraw in retirement, the taxman will come knocking. The perks are lowers your taxable income now, more money in your pocket to invest today, and great if you're in a high tax bracket now and expect lower later. However, you will pay taxes later. This can push you into higher tax brackets if unmanaged. This is where tax withdrawal tax plan comes in. There are penalties for early withdrawal and required minimum distributions later in life. Bucket 2 is for tax-free accounts like Roth IRA or Roth 401k. This is the fan favorite bucket. How it works: you pay taxes now, your money grows, and in retirement, you withdraw it tax-free. No income tax, no capital gains tax, no IRS side-eye. Pros: you get tax-free growth forever, no required minimum distributions later in life, huge flexibility in retirement. And the cons? Well, you don't get no tax break today. There are contribution and income limits for Roth IRA. Think of Roth accounts like planting a tree after you already paid for the land. Once it grows, everything it produces is yours. The last one is taxable brokerage accounts bucket. This is the most misunderstood bucket. Like the leftover Tupperware in your fridge, not glamorous, but somehow indispensable. How it works: you invest money that's already been taxed. Along the way, you pay taxes on dividends and capital gains when you sell. Think of it as a slightly responsible cousin of your money. It plays by the rules, but still gets a job done. And the pros for these accounts: no contribution limits, no age restrictions, full flexibility. Like you can move your money around like it's Lego bricks. The cons are, well, it's less tax efficient. Long-term capital gains are taxed at 0%, 15%, or 20%, so Uncle Sam still wants a piece. And yes, it requires discipline. You can't just spend it on avocado toast every month. This bucket isn't flashy. It's a utility drawer, not fancy, but incredibly useful. Now let's talk about how to stack these accounts. Here's the thing. You're not choosing one and ignoring the others. You're layering them like a financial lasagna, each layer making your money tastier and stronger. Here's a simple, non-overwhelming order. 401k match first, then HSA, then Roth IRA, then back to 401k, and finally taxable brokerage. That order maximizes tax efficiency first, flexibility second, and keeps your money working its hardest without making your brain hurt. So, the first step is to get the free money. Contribute enough to snag your full match for the 401k. That's instant 50 to 100% return. Skipping it? That's like refusing a raise because a form feels annoying. Seriously, if your employer offers free money and you don't grab it, good luck explaining that one at parties. The next step is to max out the health saving account. This is the power move. This account has a triple tax advantage. Money goes in tax-free, grows tax-free, and comes out tax-free for medical expenses. And after 65, you can spend it on anything, no questions asked. Think of it as your medical Roth. Most people make the mistake of using it like a checking account or playing it safe with conservative investments. That's like owning a Ferrari and only using it to get groceries. What comes next? Well, it'll be to max out your Roth IRA or Roth 401k. Why Roth next? It's tax-free growth forever. No required minimum distributions, ultimate flexibility. You want those dollars to sprint through life without paying a single tax. Step 4 is to go back and finish maxing out the traditional 401k if needed. Now you're reducing taxable income during your peak earning years by deferring taxes intentionally and setting yourself up to manage withdrawals strategically later. Think of it as playing chess with the IRS, where you're planning several moves ahead. Last is taxable brokerage. Last, but definitely not least, this is your flexibility account. No limits, no age rules, a bridge to early retirement, and a tax planning tool. Use it wisely with a buy and hold mindset. It's not flashy, but it's the Swiss Army knife of your investment life. Well, sure, it won't win a beauty contest, but when you need a tool, it's got a screwdriver and even a toothpick. So now you know how to build your retirement empire efficiently. But here's the kicker. How you pull the money out matters almost as much as how you built it. Retirement isn't just an investing problem, it's a tax problem. Get it wrong? And congratulations, you just gave the IRS a bigger retirement than yourself. Here's a mental model that makes this stupidly simple. The 3 fuel tanks. Picture your accounts as fuel tanks and your job in retirement is to burn the fuel that goes bad first. Think of it like cooking a 3-course meal. Use the perishable stuff before it turns into science experiments in your fridge. Okay, let's dive in. Tank number 1, traditional rusting fuel, fully taxable, required minimum distribution force withdrawals, and if you hoard it too long, it's a ticking tax bomb. Amazing while you're working, but dangerous if ignored. It's like leaving gasoline in your garage for 30 years. Well, sure, you might survive, but do you really want that stress? Tank number 2, taxable, leaky fuel, dividends, capital gains. Yeah, you pay taxes, but at lower rates. No forced withdrawals, maximum flexibility. It leaks, sure, but slowly. Think of it like a soda bottle with a tiny crack, messy if you tip it over, but controlled if you handle it carefully. Bonus, you can use it as a bridge for early retirement, or the spontaneous trip to Bora Bora your Roth isn't quite ready for. Tank number 3, Roth, premium fuel. Never taxed, no expiration date, no IRS, strings attached. People treat Roth money like rare wine in a secret cellar, or like the last slice of pizza at a party. Handle it wrong, and it's gone. Handle it right, and it's your golden ticket to sipping champagne in retirement while everyone else is arguing over who owes Uncle Sam. The rule? Burn rusting fuel first, leaky fuel second, premium fuel last. Most people mess this up and end up paying for it later. Like leaving all the ice cream to melt first and eating broccoli instead. Please don't be that person. All right, let's make this real with real numbers. Here's the assumed goal: single filer, $60,000 in annual spending, minimize lifetime taxes, preserve your Roth, and use the HSA wisely because we're not animals. The accounts we've got: traditional 401k, big balance, ticking like rusting fuel; taxable brokerage, a mix of basis and long-term gains, a leaky gas can; Roth IRA, premium fuel, handle like liquid gold; and HSA, invested, untouched, basically a unicorn in your financial stable. Here's some 2025 tax backdrop. Standard deduction of $15,750. 0% long-term capital gains threshold is up to $48,350 taxable income after deduction. 10% ordinary bracket up to $11,925, and 12% bracket up to $48,475. Now let's see the fuel tank strategy in action. Step 1. Burn the rusting fuel. Pull $30,000 from the traditional 401k. Most people blow this because they forget the standard deduction. Let's do the math. $30,000 minus $15,750 leaves $14,250 taxable ordinary income. Now applying the brackets, $11,925 taxed at 10%. It is about $1,292. The remaining $2,325 taxed at 12% is about $279. Total tax, roughly $1,471. You just pulled $30,000 and paid about the price of a used laptop. Rusting fuel, burned like a pro. The IRS frowns a little. Your wallet is cheering. Step 2. Tap the leaky fuel, the taxable brokerage. Withdraw $20,000, all long-term capital gains. Stack it with the $14,250 ordinary income. Now, the total taxable income is $34,250. Remember, the 0% long-term capital gains threshold is around $48,000? That means all $20,000 of these gains are taxed at zero. Yes, zero, zilch, nada. This fuel leaks a little, but today it's basically free gas. You're cruising on fumes. That happened to be tax-free. Step 3 is to top off with premium fuel, the Roth IRA. Now, you've already pulled $30,000 from traditional and $20,000 from taxable, with a total of $50,000. You still need $10,000. Withdraw that from Roth. No tax, no brackets, no paperwork panic, no side-eye from the IRS. Premium fuel stays premium. It's like drinking champagne in a cardboard cup while everyone else is gnawing on soda crackers. Here's the magic you just did. You lived on $60,000, but only around $14,000 was ordinary taxable income. Capital gains taxed at 0%. Roth mostly untouched. Future required minimum distributions, pressure down. Lifetime tax bill down. You see, same spending, wildly different outcome. This is why withdrawal strategy matters. Most people don't lose retirement to bad investing, they lose it to bad sequencing. They burn the champagne first and hoard the rusty gas, then act shocked when taxes explode like fireworks in July. And if you're asking, what about the HSA? Well, we don't touch it. That thing is holy grail fuel. Pre-tax going in, tax-free growth, tax-free withdrawals from medical expenses. It's basically a triple tax advantage wrapped in unicorn glitter. Let it sit, reimburse yourself later, and future, you will be so grateful they'll probably send thank you cards. Maybe even a fruit basket with a note that says, I told you so. Or better yet, a golden ticket for a guilt-free spa day. So here's the real takeaway. You don't need high returns, you need better structure. Tax advantage accounts aren't loopholes, they're incentives. The government is literally saying if you invest for the future, we won't hit you as hard. So, take the deal, because investing without a tax strategy is like filling a bucket with a hole in it. You're working hard, but all your progress is leaking out the bottom. And that's it for today's video. Thanks for watching. If this helped, like the video, subscribe, and comment which account you're focusing on next. And remember, you just need a little better structure to keep more money in your pocket. And that's how real wealth gets built, one smart, tax-savvy step at a time.